All right, all right, all right, all right. Now we are live and recording. Sweet, perfect. So I apologize, guys. I did not do market outlook last week. I've been taking a little bit of a break. Okay. Can you guys hear me loud and clear? Let me know if you guys can hear me. Yes, no, maybe. Yes, no, maybe. I think so. Anyways, so share computer sound. Okay, cool. All right, so basically, guys, I've been taking a little bit of a break, just recalculating, reassessing, restarting, and everything. We've taken a couple of L's since the beginning of the week. No big deal. We're gonna bounce right back from it. We're gonna fix our mindset. We're gonna go ahead and fix, our trading plans. We're literally gonna fix a lot of things coming into this year. I always think at the beginning of the year is a little bit difficult for a lot of traders, and the reason why is because it's a seasonality change. Okay, for beginner traders, there's a lot of seasonality changes in the market. What I mean by that is if you notice that price will move a specific way during the summer, during the spring, during the fall, during the winter. And you can go back and look at timing and price relationships, and also look at the symmetry in the market as well, and taking all of that into account, really understanding that seasonality changes can really affect our trading and can really affect some of our strategies. So what we're going to do is we're going to overview a couple of concepts that are going to help us as far as our seasonality changes. Some impeccable, I can't say impeccable, but I can say that there are some techniques that we can use in our trading that can really mitigate a lot of losses. And what that simply means is mitigating risk, mitigating our chances of losing as much by using a lot of risk management. What I tend to find when it comes to trading in seasonality changes is that a lot of our systematic approaches, as well as discretionary systems. What I mean by discretionary is it's up to the trader to make the decision when we're trading, making a trading decision. Okay, so our psychology is going to be a little bit different going into 2019, and here's why: because it's a new year, because it's a new trading time. Okay, it's a new time. Once you switch from 2018 and 2019, what you did in 2018 won't be indicative of the results that are here in 2019. Yesterday's games are not going to count for today's points, ladies and gentlemen. So what we have to do is recalibrate our minds. We have to ask ourselves specific questions. I'm not going to go over my trading plan. I usually do on Sunday Market Outlook, but I'm reframing the entire trading plan because there's a lot of new tweaks, a lot of new techniques that I've added to the trading plan. So I'm going to show you guys a final product as soon as we're done, as soon as I'm done editing it. So like I said, how do we ask ourselves, what kind of questions do we need to ask ourselves when walking into a new season, when walking into a new, into a new market? It looks like it's a new market because, let's look at it this way. When we go from a session to session, when we go from Asian session to London session and London session to the New York overlay, guess what happens? There's a gap, okay? There's a gap of data, right? So if we're moving from session to session, same thing happens in the week, right? So when the market closes on Friday evening at 4 o'clock, guess what? We have another gap in the Sunday market, okay? So I would beg to, I really would, it really begs the question, is there a monthly gap? Yes, there is. Go back in the charts and take a look. There's a monthly gap, okay? Is there a quarterly gap? Potentially. But let's talk about the seasonality gap. Let's talk about the yearly gap, because the yearly gap is this. It's not on the charts. It's not data it's not data related to candlestick patterns. It's data related to psychology of the market. It's related to how we think and how we understand how the rest of the market thinks. Okay. So with that being said, when we're walking into these new chart, when we're walking into these brand new 2019, charts up here, let's really take a look at what happened. Okay, let's take a look at price in relation to time and price in relation to the institutional levels, price in relationship to the order blocks or the institutional order flow on the daily basis. Okay, so going into Euro USD, I'm sure that a lot of people are looking at this and they're like, oh my God, there's a big choppy market. Yeah, it's been choppy for quite a couple of months, and we made a new high in January, which is, that's kind of expected. This is what I would call a mitigation factor in time and price relationship. So what we have right here is an order block in November 9th and November 9th through the 12th. Obviously, it's an order block. Here's how we determine this is an order block. Okay, so we have a big impulse leg to the downside, and then we have our first bullish candlestick is classified as a Marabuzu, I guess. Marabuzu is a reversal candlestick pattern, and what the properties that consist of this data is that we have a cutoff. We have no wick or shadow at the bottom of this candlestick, and we have a very small wick at the very top. There's a little bit of room for having a small wick at the top. It's okay, but the Marabuzu is a reversal pattern. Now, is it gonna be indicative of a move like this huge move on the daily? Not necessarily, but what it will say, if we're looking at the order blocks, we're going to understand that price is probably going to come right back out here and, dip into where the bank's orders are. That's what an order block is. An order block is simply where the banks place the pending orders in a buy or a sell market. Okay, so this is a good example right up here as well. Okay, let's go from here to here. Okay, so go ahead and place our X right above here. Okay, and we have another one right up here. Pretty big X. But here's what we did. We came in on the bearish scenario with the bullish pin bar to the upside, right? Remember how I talk about the pin bar right up here? Well, we came back inside of these pin bars and we closed. Let me move this X up a little bit right up here. Okay. So how we determine this is an order block is, let's look at where price was and the whole body of the price. Okay, so if you can see, let me go ahead and delete this green. I'm going to delete this green one right here. So as you can see, the bullish, this right here, bullish pin bar right before the bearish pin bar to the downside. This is where the orders are going to come into play, where we're going to dip into this order block, this whole institutional order flow that I'm talking about here. So when we come in here, we've already touched price, and what do you know? There's going to be a Fibonacci relationship inside of this as well. Okay. Price did not necessarily close above the 79.2. This right here would have been 79.2, 70.5, and 0.62 are going to be our sweet zones. Okay, this is where we're going to this is where our optimal trade entries are going to be. Okay, obviously our stop loss would have been 20 to 30 pips after 79.2. So when not on a daily, obviously. Look at this price. Okay, so the price that we would have entered on would have been 1.1537. Our stop loss would have had to been, probably about 30 to 40 pips, but I would have made it right up here at the 1.1621. And then our equilibrium at 1.1420 would have been our take profit. And then obviously, what we're really looking for on a long-term perspective, even though this looks kind of bearish, to me, my opinion, what I'm looking at right now is this order block. Okay, we're up to date in price and time, and we're going to be opening here in about 2 hours, 2.5 hours. And what's really interesting is whenever you're playing order blocks and you're really looking for particulars in the market like this, it's really useful to look at impulse moves. Okay, what is going to be the determinant of your optimal trade entry between you're going to get stopped out or if you're going to hit take profit is whether or not you are able to decipher where your order blocks are. The order blocks, here's the description of the order block. You guys can refer back to the YouTube video later on whenever you guys have some time. And if you guys don't understand the concept fully quite yet. Okay, so this order block right here, there's a big impulse move down, and then we move strongly away from it without any wicks whatsoever. What we call this pattern right here, this price pattern, this is going to be a railroad pattern. Okay, railroad tracks both side to side like this, very even at the bottom, and an impulse move from both sides. Okay, so those are the requirements. So with this concept alone, we're looking for reversal patterns. So we have A, railroad pattern, B, Marubozu, okay? Then we have the impulse to the upside. Now, why is this important? We're building a framework, guys, on a longer term trading scenario, okay? We can't just look at this and say, oh man, we gotta buy this all the way up. Not necessarily, okay? Reason why is because we're in a downtrend. Obvious downtrend. Let's go ahead and take a look at this real quick. It's an obvious downtrend right now. Okay, this high wasn't taken out. This high wasn't taken out. This high has not been taken out quite yet. Okay, is there structure in here that's been kind of violated? Yes, yes, and yes. This structure right here at 1.1340 was violated. So if it got violated here and here, kind of begs the question, where are we going longer term? Okay. A lot of us are looking for, and this is why fundamentals come into play so dramatically. So, as you know, Jordan Morgan and Zach, a lot of the trade houses already disclosed the fact that when we're looking at the dollar index, when we're looking at the dollar index, what we're really looking for is, I'm going to go ahead and pull it up right now. Just to kind of clarify some things about the rate hikes that the Fed has been enacting lately. They have been putting way too much. They've been raising the interest rates quite literally too fast. Okay, and they've raised the interest rates over probably about a 1 to 1.5 ratio. So what that simply means is that it's just there's too much interest and there's not enough value in the dollar. Okay, so let's go ahead and take a look real quick. Okay. So, again, you know, these are what's really important about all of this. Like I said, here we are, right? Again, railroad, Marubozu. We've got a really good scenario for a sell. I know that this looks kind of, kind of particular right here. This could potentially be this is an uptrend. Let's not confuse this. This is an uptrend in the dollar index, okay? But let's also take a look at the reversal patterns and the reversal signs because we have not been able to break above 97.61. Okay, if we cannot break above 97.61 and we have I feel like a confirmed order block right here, and we've been reaching in here, and the reason why I'm looking at it in this perspective is because if the banks have not gotten enough orders to make their money back from taking an uptrend all the way up, they're still manipulating the dollar index too. Okay, so while they're manipulating the dollar index, we're sitting here thinking, oh, hey, look, we're in an uptrend, blah 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 blah. We're gonna go ahead and buy it. But here's the fact of that right here. I'm gonna go ahead and highlight this. This entire area is an order block. Why? Because I look at these gaps right here as liquidity zones. Somewhere in this area is the liquidity zone, and we've already closed. Look, we've closed in price inside the liquidity zone. So what is that going to tell us? That's going to tell us that this entire area right up here in this red box is where a lot of the banks are placing their orders. They're placing a lot of sell orders up here, ladies and gentlemen. So. Looking into Euro USD, why we're buying it is because of this mitigation zone right up here at 97.60 and 97.10. It's already dipped 1, 2, 3, 4, 5 to 6 times inside this zone. So when we're looking at Euro USD, we're looking for a bearish US dollar and a bullish euro. The dollar is obviously, now I'm not going to say that we can guarantee that any of this is going to happen. Trading disclaimer, past results are not indicative of future results or profits. So what I'm thinking in my personal bias is we're more than likely going to take this order block all the way up. I'm saying up to about 118. Why? Because we need to take these highs out. We have not taken these highs out up here yet. And I think that would just be I feel that this would be just oh God, a beautiful trade. Now, what's going to end up happening once we get up there? Who knows? Who knows? Honestly, who knows? But what I will say is what can happen inside of this block right here. Let's look at this little grid right here, this little grid box. Okay, I say this grid box or this grid box right up here in June. This is going to be a longer term trade. This is right now we're in February, mid-February, February, March, April, May, maybe a 3-month trade that we may be able to hold it up to 118. And we're going to look for some scenarios where we're going to be able to sell it off again. Why? Because what happened back in last year when we started doing this in February and March. So we sold heavily up here in this area. This is when we started calling some trades, okay? This is whenever our traders started to come out with some signals and stuff, okay? We started sending signals from February. We started sending signals of a buy in February because we had a nice, harmonic pattern up here. And then, what do you know, we sold it off. We didn't hold the trade, obviously, but we've walked Euro USD down quite a bit to, let's look at this gap down here. There's a big, big gap, okay? To this gap right here at 1.70, I still believe we're going to be able to reach that, and here's why. Because of this level right here, we're going to have to take this high out, right? We're going to have to take this high out of 117, 118, and revisit these areas of potential resistance, okay? Potential reversal zones. You remember how I keep talking about that in my in our trading plan, because this is the Ozark trading experience, obviously. What we're going to look for is a bounce and recovery to the downside, because obviously we've been selling for freaking ever, for a whole year now. Does that mean that we're going to continue? Does that mean that this right here is this is a heavy support zone, guys. Right here is a heavy support zone because it's stopped right here. It's been choppy right here. There's no market here. There's no market to sell or buy in this area. Big, heavy support zone. So why would we look to the upside if it's been choppy like this? Because it's an accumulation zone. It's just that simple. It's accumulation. All of this BS right here, it's all accumulation. Okay, so moving on into USD JPY. Obviously, if we see that the dollar index could potentially be bearish, then we could potentially see USD JPY. Obviously, Japanese yen being bearish as well, or the Japanese yen being heavily going here really quick and read some of the. We don't need to allow people to talk during this thing. Anyways, so what we're going to look for, this is kind of funny because we already hit the 200 EMA. Not really super, important, but what's really important is looking for the order blocks, and this right here is an order block, okay? So with this order block, what are we going to expect? We should have already taken a high out right up here. Not a big deal if we don't. But we did reach inside of this entire zone, and we had a nice gap on the daily. So indicative to my trading plan, personally, a downtrend. And Japanese yen obviously being stronger than the US dollar, okay? So what I'm really trying to help you guys understand is that order blocks can help you. Order blocks are, like I said, order blocks are where the banks place their orders, the bigger players in the bank. So let me just, who makes up the majority of? Who makes up the majority of the Forex market? Okay. Okay. The market is largely made up of institutions, corporations, governments, and currency speculators. Okay, so what does that mean? Well, let's go on in here. For those of you that are kind of new trading, Where is the litany of litanies? Okay, hang on a second. I gotta find that article that Jordan sent me. I'm like over here, don't even know what I'm doing. Anyways, Forex market size. Beautiful. That's what I was looking for. Cool. So let's look at this really quick. Okay. Okay. So reporting dealers, other financial institutions, non-financial customers. Okay. So that means that so there's an article which I'll share later on. The majority of the central banks, including the institutions of JP Morgan, Goldman Sachs, and a couple of other big names out there, these are the financial institutions that are dealing in Forex. And then the reporting dealers, this is going to be our brokers. The brokers are part of the financial thing too. They make money on us, and they make money on the financial customers, right? So here's us, this little sliver of 7%. We're 7% of the market, okay? So when we look at these markets, it's not speculative, okay? It's not by chance. It's not by timing. It is by timing, kind of. But it's not by chance. It's by understanding that there are institutions that are bigger. There's big money dropping 100K lots. Trust me, 100K lots in order to move price. Because how else would price move? We're using what? 0.01s, 1.0s, 10s, 100s, whatever. We're using very small lot sizes compared to the banks, okay? Those orders are not going to move price, okay? Us as retail traders, we are trading with the banks, not against them. We can't trade against the banks because our orders are nowhere near as big as their orders, okay? So when they place orders up here, they got 100K worth of orders up here, 100K lot sizes. I'm talking about like 100,000 lots or more dropped in these areas, these orders, okay? So when we want to try to buy something up here, instead they're going to try to sell this stuff like right at 97.51 or right at 97.61. We're overpowered, dude. We're overpowered, bar none, 100 to 1 or 1,000,000 to 1 if you want to look at it that way, because they're trading with billions of dollars, guys. This is what I want you to understand. And I might make some of this content exclusive too, because I don't know if I want to put this on YouTube. I'm going to, but this content is extremely valuable because we understand that the banks move price. And you can understand where they're putting their orders. You can understand and attempt to understand. Now, we're not going to be 100% accurate. Can we be anywhere from 60 to 70, maybe even 85, maybe 80%? I don't know. But it's a pretty accurate, it can be somewhat accurate when we understand where order blocks and where institutions are placing the trades. Because it wasn't up until recently that we discovered some of this information in order to trade with the big banks, okay? A lot of people are using Fibonacci, stochastics, and blah, 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 all these other, technical indicators. And of course, look, you don't even see my RSI on here anymore. My RSI is no longer here. It's no longer valid, okay? I stopped using the RSI because these techniques that I've been learning are so valuable and so accurate that I'm just like, wow, okay. Well, harmonic patterns don't work. The RSI, the divergent stuff, that can work, but it's still retail trading. We're trying to trade with the banks here. We're not trying to trade like retail traders. We're not trying to lose all the freaking time, okay? So with that being said, ladies and gentlemen, this 30-minute video that I'm going to post here in a little bit is going to have a follow-up series on risk management. It's going to have a follow-up series on stop losses. It's going to have a follow-up series on sniper trading, okay? What I mean by sniper, I'm talking like sniping entries, crazy wick entries, ladies and gentlemen. So with that being said, go back to YouTube, subscribe, watch these videos over and over and over again until you understand these concepts. I'm going to go into more detail. I'm going to need some feedback from you guys, okay? I'm going to need some feedback. Go into YouTube and give me some feedback and let me know what else I can explain better and in more detail so we can all grow together as traders. Remember, ladies and gentlemen, love, like, subscribe, and share this information with as many people as you possibly can so we can free people financially from these banks, from the monotony of the 9 to 5. All right, guys. I love you guys. Peace out. Take care and learn much.